Welcome to Law Scribe Media. We are here today with Saad Mahmood. He is a engineer, a software developer, a neophyte investor, and also sort of tech geek. And we're here today to talk about cryptocurrency like Bitcoin, etc., the mining process, and kind of the history of money and everything like that, so people can understand, certain options they have available to them in this modern day with, all the changes and things like that. Welcome to the show, Saad. How you doing?
I'm doing great, man. How are you?
Good. So let me give the listeners a quick rundown, just a quick brief history of money in terms of exchange. So obviously throughout history, we've had a variety of different means of exchange. We've had barter systems, fiat systems. One of the things that we had when, many thousands of years ago was just, coin-based, interactions with individuals, people being able to exchange based on gold, people also exchanging based on resources and things they had available to them. And it was a variety of different things throughout history that have been a means of an exchange. Now, what happened a few hundred years ago with the Rothschilds dynasties and the Talmudic banking dynasties is that they created not only the fiat currency, which was, essentially paper backing of gold assets usually, but it was also the fractional reserve concept, which means that, let's say, I say take my money for safekeeping, or keep this much on deposit for me and then I can come back and take it. Let's say it was 100 gold coins. Fiat currency through this mechanism of paper, and then also through fractional reserve banking, they would lend out 90% of that, meaning 90 of the gold coins they would lend out to other people with interest to pay it back. Now, interest in the Abrahamic religions technically is against the religion, but Judaism obviously has morphed, and so Judaism does allow usury, whereas Christianity and Islam does not. Now, one of the things I'm sure that some of the viewers will know is that in history, the Jews claim that the Christians essentially made them become money lenders, as if they would not be allowed to be artisans or blacksmiths or other normal occupations in the Comedy of Nations. But what they decided that this was something that they knew how to do. This is something that they've perfected over thousands of years, and even according to their halakha, they are able to exchange with individuals in their own community without usury, but in the outside community amongst the Goyim/Gentiles, they do use usury. And the reason why, of course, is against the divine order of things is that it creates money out of nothing. If I give you $5 and I'm the only creator and purveyor of dollars, then how can I ask you to pay me $5.25 back, right, within a certain period of time, because you can't create that money out of nothing. And so the entire money supply is debt. And by doing so, they just essentially own the nation. So then they have wars, and then those wars, obviously cost a lot of money, and they are the ones who lend the money to lots of different sides in those wars, and then those countries have to pay it back. And if you look at the rise of Hitler in Germany, that's it was a result of what they did in World War I, and then the burden of all the nations that were against Germany being put on Germany as like the lone evil character on the scene. And that's why Germany was suffering from so much crazy inflation and things like that. And Hitler rose to power and basically excised these individuals and took them out and got rid of the usury system. Abraham Lincoln tried to do the same thing here. Andrew Jackson did the same thing here. John F. Kennedy tried to do the same thing here, because as long as it's a fiat currency and it's has an interest requirement, it's a usury based system, the individuals who print the money exclusively will be the ones in control. Recently, in the last, I would say, 7 years or so, there's been the emergence of cryptocurrency. And with cryptocurrency, a lot of things have changed, and there's a more democratized access to the means of exchange. And now with the facility of the internet and the data storage being the way it is, it's become a very fascinating subject. It's been a great opportunity for investors who got in early. Now, that may continue or that may not continue, and it may become dispersed. So we're here today with Saad to discuss some of those things. So Saad, tell us, what is cryptocurrency?
All right, so cryptocurrency is a form of digital money that is designed to be secure and also anonymous. So it is a currency associated with the internet, and it uses cryptography, which is just a process of converting legible information into an almost uncrackable code. What it's used for is to track purchases and transfers. And cryptocurrency is just a medium of exchange, like normal currencies, like the US dollar, but designed for the purpose of exchanging digital information through a process made possible by cryptography. And it's used
Can you go into more detail on what cryptography is?
So cryptography is basically like so. There's a public key which you have, and you use it to send information. A private key that you have, then you use it to send information, and other people will receive a public key which you provide, and they can access that information. It's been used. Yeah, it's encryption, and it's been used across different means of transactions already, and data transfer already. So the cryptography part is nothing new. But where crypto separates itself from centralized banking, like the Federal Reserve System, for instance, is because governments can control the value of the money through a process of printing the money, like you mentioned. But on the flip side, governments have no control over how cryptocurrencies are managed, and thus crypto is fully decentralized. And most cryptos are designed to decrease in production over time, so it's almost a complete anti of what fiat currency is, which is constantly printing money as needed, thus increasing inflation. But if you decrease the amount of crypto over time, then you have created a market cap. And that is why crypto is valuable and can be used in many different ways, which we can go into.
So crypto does have market caps, meaning because one of the reasons why there's runaway inflation and there's perpetual interest, and why that within the current capitalist system, they have to continue to exploit new nations and extract their labor and take that margin as profit, and then of course hoard the wealth. It's because of the fact that it's an endless growth of the amount of currency available. So how does cryptocurrency differ in that regard? Because if it's infinitely available, then obviously over time it will become devalued.
Yes, so pretty much all, and I'm not sure if I know of anyone, all cryptocurrency has some sort of market cap, some sort of maximum number of coins that people can have. And some cryptos are they burn, which means as you use them, they decrease. Others are just capped off, or once they're transferred out or exchanged to another currency, that coin no longer exists. So basically, over time, pretty much the cryptocurrencies decrease. So thus making them more rare over time.
And more valuable individually.
Absolutely.
So it always is going to decrease, or will it ever? You're saying it's always going to decrease, or it's stabilizing at some point?
Yes.
What are you talking
about? So most coins burn. So what they'll do in order to combat that burn is by removing a decimal point eventually. So let's say Bitcoin, for instance, would be worth maybe 0.1 Bitcoin in the future. So that way you have the same number of coins, they're just worth less. It's like splitting a stock, right? So the total market cap remains around the same and actually will decrease over time. But obviously, if somebody already has millions and millions.
What if there's growth? What do you mean the market cap is going to decrease over time?
Well, there's growth in the sense that the market cap is related to US dollar, can increase over time, but the actual number of coins over time will decrease. And in order to combat that, so that currency lasts longer, they'll eventually start moving decimal places, so that people who have let's say 1 Bitcoin would now have, which is worth whatever it's worth, would now have 0.1 Bitcoin. And of course, as Bitcoin increases in value, or any coin increases in value, that will still be worth a lot.
Mm-hmm. Okay, so Bitcoin obviously isn't the only one, but tell us about Bitcoin, because I think it came out in 2010 or somewhere in that neighborhood, 2009 maybe.
Yeah.
And like you said, I think you told me offline that they were giving them away at that time because they wanted adoption.
Basically.
So tell us about Bitcoin, its history, and what it's like now.
So Bitcoin was basically what started the ball rolling for all these cryptocurrencies. It was created by an unknown person who uses the alias Satoshi Nakamoto. So we're assuming he's somewhere in maybe China or Hong Kong or Japan, that part of the world. But again, we don't know anything about this guy. So basically what he decided was that you can create a currency which we can back by some form of fiat currency for now, but we're going to allow this transaction to be made
as a means of exchange.
As a means of exchange.
You can understand its value relatively.
Absolutely, yeah. So a transaction would be made with no middlemen, like banks. And there's no transaction fees, and you don't have to give your name. So this kind of opened the floodgates for a lot of illegal activity in the beginning, because people were using it as a means of the black market exchanges to weapons or on the such. But for most people, they would use it as just to do their normal transactions. So Bitcoins can be used to buy any merchandise anonymously. In addition, the international payments are cheap because Bitcoin isn't tied to any country. So therefore, there's no international transaction fees that you might have to pay.
Also, it wouldn't be subject to international turmoil in that sense.
Absolutely. It's like completely
Because
irrespective.
George Soros, for example, was able to destabilize the currencies, well, many countries, but specifically in the 1999, in the year 99, he was able to crash a lot of Asian economies, except those that did not take loans from the IMF. But that was because he can manipulate the supply and demand.
Exactly. And also, lastly, small businesses really like Bitcoin because there are no credit card fees. So, people that are, have their machines like merchant services and are paying high rates on their transactions, this doesn't become a problem with Bitcoin because, again, it's not tied to banks, so it can't be tied to credit cards.
So you think that this cryptocurrency eventually could totally dismantle the edifice of merchant services and payment processing because of the fees associated with it?
Unless those credit card companies lower their rates substantially, yes, there are cryptocurrencies out there, and one of them I am invested in, and I'll talk about it later.
Yeah, because my career has actually been in merchant services, and the majority of the fees that accrue to a business, and we're talking about whether it's the smallest business on the corner or Best Buy, Walmart, it's the interchange, and that's Visa, MasterCard, Discover / the issuing banks, and they all have different fees. So debit cards have certain types of fees, and credit cards have certain fees, and it comes from the rewards, right? Because you get rewards if you go to like gas stations or other places, and specific months sometimes you get 5%, 2%, 3%. Well, where is that coming from? It's coming from the individual that you're purchasing from.
Absolutely.
Because they're absorbing that cost with the cost of the transaction, because they're getting the money before the money is ever available. Because credit is credit, they're getting the money the next day sometimes. So for that, they're paying that fee. So you're saying potentially it could change those things, because Interchange was sued by Target, Walmart, and Best Buy and a few other large retailers because they said, you guys are charging basically 1%. So for every $100, there's absolutely no way we can avoid paying at least 1 to 1.2% to you guys. That's
Right.
not even like people like me who are in the industry. That's the interchange, racket
Absolutely.
essentially. So you're saying that could actually change because of cryptocurrency.
Well, yes, because currently, this is a rough estimate, $1.6 trillion were spent in transaction costs this past year.
Yep.
Which is an insane amount of money just to
it's an insane amount of money for them to make.
buy something.
Yeah, and
So-
for them to make.
Exactly. So there are solutions out there that would address this, and I can get into those later.
Okay.
There's a funny story with Bitcoin. So, like you said, initially people were basically given Bitcoin for free in the beginning, just to sign up on their platform and start using it as a means to buy things. So some guy used 100 Bitcoin to buy a pizza one night, and just to give you kind of like a point of reference there, one Bitcoin is now worth about over $6,000 US. So
Wow.
this guy spent $600,000 on a pizza in today's
Wow,
in today's currency.
that's
So
crazy.
it's just
No, but a lot of the value of it is speculation, though. It's speculative because it's something that, obviously if it has a limit in terms of how wide it can grow, how many coins there are, essentially
Exactly.
there's certain that they can still mine. We'll get into the mining in just a second, but if there is a limit on it, then obviously the value is up to the individuals who are involved in exchanging it, because some people are not giving their coins up, right, because they know
Right.
that it's going to continue to go up, and
Absolutely.
other people are taking advantage of the high speculative cost currently. So it may not always stay at 6,000. I mean, it could dip significantly from there, and it could go obviously much further.
Absolutely, and think of cryptocurrency exchange as like a stock exchange. People will hold, right?
Right.
And they will wait over time and see. I invest, in Apple in 2007. Now today, I'm basically a millionaire.
Well, speaking of Apple, the guy, one of the early people, he had been given 10% of the company or something, and he sold it almost instantly for basically pennies, and now his stake would have been worth tens of billions of dollars, if not hundreds of billions.
Hundreds of billions, probably.
Hundreds of billions, probably, yeah.
At this
Because it's
point.
almost $1 trillion company now.
So yeah, I mean exactly. So, but the thing is, you're right in the sense that it is speculation. But the thing is, as long as people continue to buy it up, as long as people continue to demand more, and the cost goes up and up, people are saying, and again, speculation, that a Bitcoin could be worth 10,000 very soon, which is very possible since it's already at 6. Some people are saying that Bitcoin could eventually be worth $500,000, one Bitcoin. And I think if it ever does reach that point, that's when we'll see most people won't have one Bitcoin. They'll be or they'll have denominations, right? They'll start breaking it down. So like one Bitcoin won't be worth 500,000. That'll just be ridiculous.
One Bitcoin would be like having like $10,000 or something, right? So it's like, that's not how you go to the grocery store. You go to the grocery store in segments of that. Right?
Exactly, and that's another like benefit of cryptocurrency is that you can, and which you can't do in the stock market, for instance, is you can buy and sell fractional amounts of the currency, right?
Mm-hmm.
So most people can't buy and sell in units of one, for instance, of Bitcoin because it's expensive. But you can sell like 0.001 Bitcoin and buy 0.002 Bitcoin, whatever. Like that opportunity is there for people, and then you can build your accumulation slowly over time as you would with any stock.
Okay. So. Now there's a new concept that that some of these new currencies are essentially based on. Tell us about that. That's called blockchain technology. What is blockchain technology?
So at its core, blockchain technology provides a method to make those electronic payments without needing that financial institution as a go between, like, for instance, banks, credit card companies, PayPal, whatever you can think of. And this is a bold assertion that runs counter to the current trusted third-party system. Because how does it accomplish this? And for any system to make a claim like this, it must provide the following at a very minimum: a strong control of ownership and the prevention of double spending. So we can go into
double spending.
Yeah, so we can go into double spending here. The double spending problem is basically this: a person uses, let's say, writes a check, right, for $100, right, to somebody, and he writes another check, right. And when that check gets to the other person, who, depending on who cashes that check first, would get that $100. So this is a problem in the sense that the second person, obviously, he's going to get rejected based on his when he tries to cash his check, because that's the way the current solution is. It just looks at, hey, what was there? What was cashed under this number? Oh, okay, so this transaction is also coming in under this. We can't allow this because it's already happened. And for the blockchain, for this to work, we don't use that central authority like a bank to determine whether a transaction is valid or not. And so instead, computers that are participating in the blockchain network, they share an open, let's say, database or transaction list, and of all the transactions that have taken place for every account. So each new transaction is broadcasted to all the available computers that are currently running the blockchain for verification. And if a majority of the computers agree to a specific transaction, then it's considered valid and it's added to the list of transactions known as a ledger. This is a simplistic term, but I don't want to go into too much technical details about this. Basically, the high level is this: a blockchain is a ledger or a database or a list of all transaction history, which is validated by all computers running that blockchain or adding to that blockchain. This is good because, one, the more people that use it, the more validation you can get, and you become very secure. That whole network becomes secure, and the transaction history allows people to understand where they are in the chain. What that means is every time a transaction is written to the blockchain, eventually a block is created and added on top, and then transactions write, and then another block is created, and then transactions are being written in, and then another block is created. And what is the purpose of those blocks? And that's where I think we can talk a little bit about the mining that you were mentioning earlier. Mm-hmm. What does it mean to mine? Right. So basically, you want me to continue on this?
Yeah.
Okay.
Go ahead.
So basically, what mining is, and I'll talk about Bitcoin mining for now. So Bitcoin mining is the process by which the transactions are added to that public ledger or that transaction list known as the blockchain, and also a means through which new Bitcoin are released. So remember, the guy that created Bitcoin in 2009, Satoshi, the alias, there's about 20 million Bitcoin out there, okay? But they're not all currently in the open market being transacted, right? Mm-hmm. They're locked up in some way through some like private algorithm, and it's holding all these coins. And the way that those coins are released is by adding to the blockchain, and the way that happens is by mining blocks. And what mining means is basically involving basically computation, trying to solve or crack an algorithm. And the participant who first solves that algorithm gets to place the next block on the blockchain. And then doing so, there's an incentive to doing this, and it's called claiming the reward of mining a block. And each blockchain for every currency has a different reward. But what this is doing is it's securing the network of transactions in the process. So mining blocks for any cryptocurrency, you're actually securing their network and allowing the transactions to be very stable and safe and secure. And so, for instance, if you mined a block of Bitcoin today, like a mined a block, that means you added it to the blockchain ledger, your reward would be 12.5 Bitcoin, which in today's money is over 70,000 US dollars. So it's a race.
What's the process of mining? You would have to have.
So basically, you really, to put it really simple, you need a really powerful computer. And the reason why you need that is because it has to literally try every possible algorithm, and it tries and tries and tries until it is able to crack that code and thus able to mine a block. So, and everybody at the same time, so let's say there's something called a block height, and that height is just a number, and eventually you'll reach the maximum number of blocks. So I don't know what it is for Bitcoin right now, but there's a number of blocks that you have to reach, right? Because that's when all the coins would be gone as well. As in, they're not going to be all locked up, and then it'll just be an open market of exchange. But so that block height is broadcasted to everybody. So everybody knows the current block height. It's some number, like let's say 100,000, right? So the current block height is 100,000. So everybody in the world is trying to mine the block height 100,001. Okay, so and because there's so many people mining, the difficulty of mining that block increases because more people are putting their computing power into it.
Right, so you're not running the same attempts as the other people are because those attempts didn't work. So you're
well, you could be running the same attempts, right? So two people could be mining using the same algorithm, and there's like mining algorithms out there that you can like install on your computers and just have them run against the Bitcoin blockchain. But the thing is, it's a race. So for instance, if I have my MacBook Pro, for instance, here, and it's a nice powerful machine, but it's not going to do crap for me basically in terms of mining Bitcoin, because the amount of power that this thing can process at one time, the amount of transactions that it can make per second is way lower than, for instance, a supercomputer. And I think I'm sure people have heard of like John McAfee. He's the creator of the McAfee antivirus software typically found on Windows machines. He recently bought literally like warehouses and warehouses of space and spun up a bunch of supercomputers in them, and they're all mining Bitcoin right now. So you can just see like what you're going against these days when you're trying to mine Bitcoin. And
Bitcoin, of course, is one of a variety of different cryptocurrencies now. So Saad, tell me, how does the blockchain prevent double spending?
So the double spending problem is a bit more difficult to solve. To meet this requirement, a system has to ensure that users cannot spend the same digital cash multiple times. A consequence of this requirement is that once a transaction is completed, it should be irreversible. Otherwise, users will try to revert their older transactions and reuse that digital cash for a new transaction, thus gaming the system. So let's start with our current system, the banks. What happens if I have $100 in my bank account and I write $100 checks to two different people? So we can be pretty sure that the first person to cash the check will get that $100.
You're saying if the check has the same number?
Huh? No, I'm saying if the check has different numbers. Let's say I have only $100 in my bank account, right? And I'm sending a $100 check to two different people. Basically, I would go in a negative balance, right? So you can be sure that the first person to cash the check will get that $100, and the second person will get the rejection from the bank saying unauthorized or whatever. This will be true even if the checks were cashed at different locations, since all branches of the bank will have access to a central account. So for blockchain transactions, there is no central account, right? It's validated, as I mentioned, by computers, by people that are running against the blockchain. And all of them in majority have to validate a transaction in order for it to be a valid transaction. So for instance, let's look at the two check scenario in the blockchain system. If I send out two transactions for my digital cash and both transactions are broadcasted to the network, it's possible that some of those computers will validate that first transaction and some will validate the second. But did I trick the system by like double spending the cash? No, because the majority rule applies to blockchain transactions. So whatever the majority approves on the blockchain, remember, everybody has the height of the blockchain at all times. They know what the transaction history are on the blockchain at all times. So everybody is mining against a certain blockchain at that point in time. So if they see, okay, this transaction came in, most people see like transaction A come in, then that is the transaction that will be validated, and the other one will be basically discarded. That way everybody is consistent, everybody knows at all time what is the true valid blockchain, and people can proceed from there.
So the transaction that's approved by the larger group of nodes, that's the one that's going to make it into the ledger?
Basically, yes.
Okay. Now, tell us about smart contracts and how Ethereum pioneered, because Ethereum is another cryptocurrency, how they pioneered in that regard.
So smart contracts are essential in cryptocurrency transactions because they help you exchange money, property, anything of value without avoiding the services of a middleman. The best way to describe smart contracts is to compare the technology to a vending machine. Ordinarily, you would go to a lawyer or a notary, pay them, and wait while you get the document. With smart contracts, you simply drop a Bitcoin into the vending machine, aka the ledger, and your escrow, driver's license, or whatever drops into your account. More so, smart contracts not only define the rules and penalties around an agreement in the same way that a traditional contract does, but also automatically enforce those obligations. So as long as a person A is selling something and person B has said that they will buy it, once person A's fulfillment based on the contract that he developed on his side is fulfilled, that transaction occurs seamlessly. So let's go through an example with this. Suppose you want to rent an apartment from me. You can do this through the blockchain by paying in cryptocurrency. You get a receipt, which is held in our virtual contract. I give you the digital entry key, which comes to you by a specific date. If the key doesn't come on time, the blockchain releases a refund. If I send the key before the rental date, the function holds its releasing both the fee and key to you and me respectively when the date arrives. The system works on the if-then premise, which means if something happens, then something should happen. And it's being witnessed by hundreds of people, obviously monitoring those transactions, right? Because it's on a blockchain. So if the transaction isn't approved by the majority of the people, then that transaction doesn't go through. So if I give you the key, I am sure to be paid, right? If you send a certain amount of Bitcoins, right, based on our agreement, you receive the key. Right. So this document automatically cancels after the time, and the code cannot be interfered by anyone else. So without the other knowing, since all participants are simultaneously alerted, right? So when the valid transaction has occurred, when that is finally done, boom, broadcasted to the ledger. People are writing it to the ledger, trying to mine the next block. So the way that this works is, it's pretty high. It's pretty high level stuff, and I'm sure like most people might not get it the first time, but just think about this in it this way. I know what I want, and this is what, like, I have like some document and I know what I want, and I write it all in that document through you mentioned Ethereum. So Ethereum is one of the biggest cryptocurrencies in smart contracts. In fact, they probably invented it on the crypto platform.
Saying, yeah.
So let's say I would go to Ethereum. I'd be like, hey, I'm trying to sell my bike, right? This is how much I want for my bike. This is where the location of my bike is. So once somebody buys it, I want it shipped to that person's address. So what I require from the other person is their address, the amount of money that I asked for, and any shipping or handling or whatever that may come. So that's it. So whenever that person sees the bike and they like it, they just click buy. Boom, that's it. They don't have to worry about anything else. So they have now agreed to send, let's say, $100 of Bitcoin to me in exchange for my bike. So now my shipping company, wherever I've kept the bike held, right, will now release that bike to that person and send it. This way, with this basically, it solves the problem of trust in society.
It reduces risk.
It reduces both people's risk, right? The person A doesn't get his money, right? And if he doesn't get his money, that means his bike hasn't been bought yet. And person B doesn't get the bike because he hasn't paid the money. So it basically prevents either person from getting screwed, because trust is one of the biggest issues in society. Something like Craigslist, if you're buying something expensive, like let's say an iPhone from Craigslist or something, there's a risk, right? Because those people, you got to buy it in cash, right? And you could get robbed. right? Or the person might give you a bad phone, right? Like these are all like things that can happen with like something like Craigslist, but something that is in crypto, it's much more it's practically impossible to get screwed in crypto.
But what about that guy that was able to hack? Was it he hacked Ethereum or something like that, and basically swindled over $150 million worth in like one transaction?
I'm not exactly. I haven't looked into the details on how
I'll
that
have to get
happened.
the details and put them in the description when I get done with that.
Yeah, absolutely. But what happens is, and I think the way that happened is something called the 51% rule. Okay, because remember what we said: majority of computers have to approve a transaction, right?
Mm-hmm.
So this guy that hacked Ethereum, right? What he probably did was generate enough computing power, right, and had enough computing power at his disposal to basically drive people away from the true blockchain and onto a forked blockchain. So what it is he got somebody to commit to an invalid transaction, because what happens, right? For instance, let's say
you're lining up two people.
So let's say you're thinking of this as the blockchain growing up, right?
Yeah.
So people say, what happens if two people mine a block at the exact same time? What happens to the block? So what happens to the block is it's still a valid block, but it doesn't get added to the blockchain. It gets orphaned off, which alerts people, anybody who's hitting that orphaned block, it's got some sort of flag or feature on it that allows you to know that this is orphaned, to, hey, get back on course and start mining at this block height, because this block height is like not valid. So what he probably did, is my speculation, is he had enough computing power to override a good transaction with a bad one, right? So it's like when you have two transactions, which one's valid? He made people basically go to the invalid one because he had enough computing power, enough computers to vote yes on that invalid transaction, and thus was basically buying back his Ethereum for free. So he was basically recycling Ethereum for himself. And basically, when somebody does this, sure.
How do you prevent that on a massive scale?
On
Because
a
obviously
massive
state actors would have massive resources. Non-state actors supported by state actors would have massive resources.
So the way they've combated this, some of the solutions are varying the complexity or the difficulty of mining a block. So if they see that an attack could be imminent, the system is designed to make it so much more complex that their computing power still would not be able to mine, right? So like, just so that, because what happens is if somebody does that to any blockchain, they've also, they've gotten back a lot of coins, right? But they're also damaging their own wealth, because people will know, hey, Ethereum is screwed up right now. I'm not investing in Ethereum. But
if you got everything for free, then you're just gonna wait it out.
Sure. I mean that. So there are certain steps that are being taken into place. I don't know the details about those steps on how they prevent them, but for the people out there who are very interested in this.
But it seems like smart contracts are basically going to be a fundamental key feature of a lot of cryptocurrencies moving forward.
Oh, absolutely.
Because what it seems like what they're doing is they're just putting more strata of abilities and skills and technology on top of what cryptocurrency actually is, meaning they're just giving it more manifestations of use.
Cryptocurrency by itself is nothing, right? It is just a currency. It's just a way to pay for transactions.
Exchange, yeah.
The exchange. What's the true value is in the blockchain and in the smart contracts. That is where the true value of these currencies lie. But anyways, for the people like you mentioned, for that, like, what if a hacker like goes in and like attacks a currency? People can look into the concept of a 51% attack. Basically, you need a majority, right? And 51% would be majority. So if somebody comes from the outside and like kind of falsifies the validation and like gets people onto another complete track altogether, and then he's like basically getting free crypto as a result. He's mining, like, because that new transaction, like, not a lot of people are mining those blocks, right? So you've basically fooled the system into saying, oh, maybe this is the valid block, and like people get machines would get confused and they start mining on the invalid blockchain, and it's easier to mine invalid blocks because there's less people hitting those computers hard, but you're still getting Ethereum because the system as a whole doesn't know, right? Like, it's up to the computers that are mining that tell you what the valid block is. That's very, really in deep. So for people that are just getting into crypto, don't worry about this.
Let's start bringing it down. So
It's-
right now there's several dozen, at least, I would say, cryptocurrencies.
Sure. If
Now,
not
of course, not all of them are quite valuable yet, and I would probably argue majority of them will never really become very valuable, just because of the widespread nature of them. But they're all now, it seems like, incorporating obviously blockchain technology and smart contracts. So there's we know about Bitcoin. That was the pioneer. I think, was it Ethereum that came after Bitcoin?
Yeah.
And Ethereum was stable and very low priced for most of its history.
Yes.
When did it come out? 13?
I'm not sure exactly when it came out, but I can just give you kind of like
Because it moved up really quickly.
it moved
this year.
insanely
right?
fast. You can say exponentially, really. So
Tell
in March,
them about the percentages.
yeah,
because
back in March of this year, Ethereum was worth about $3, $3 to $6. That's
Wow.
about it from what I
Okay.
remember. Today, Ethereum is over $300.
Wow.
So anybody that put $50 and then is basically multiplied their money by 600, 300, 100, I should say. Yeah.
No, 100, 1,000, right?
Well, multiply their $3 by 100. So whatever they put in,
Mhm.
multiplied by 100.
Okay.
Right. So which is incredible gains. And the reason why Ethereum is so successful is, one, they introduced this concept of smart contracts to cryptocurrency, and another reason why is that people are using Ethereum because
Right. It had a critical mass of adoption that led to the wild fluctuation.
oh, of
in
course. I
price.
mean, it doesn't just grow on its own. People
Right.
understand the value of what these coins can provide, or these blockchain technologies can provide, and that's why they invest in them. But one of the another big reason why Ethereum took off is because, based on, you can create your own blockchain on Ethereum using their customized blockchain, which means you can basically spin up your own entire new cryptocurrency, and that people can buy and sell on an exchange. So there's
you just have to differentiate by adding probably value in a different way that people don't understand yet.
absolutely. So like a lot
You
of
have
people
to
are making
preempt
kind of
them.
like stupid coins on there, which like just for fun maybe, and some people buy and sell them because they're like, okay, who knows, maybe this will become the next Bitcoin. But really, you have to do a little bit more research than, oh, maybe this will become the next Bitcoin, because
Right. So Sia, tell us about Sia, because I know that you're invested in Sia. So tell us about what Sia's platform is like, and why there would be a mass adoption event at some point.
So I'm really, really into Sia. For the viewers out there, Sia, I believe, is going to be
Sia spelled SIA.
SIA. Is going to be the future of decentralized storage. So the way we have decentralized transactions in crypto, think of storage as something that cannot be traced, as something that can be secure and stable and cannot be hacked. So think of it in that same sense. The idea of SIA originated at a hackathon at MIT in 2013. Since then, the developers who are MIT graduates have been working hard to develop this platform, which would basically allow you to store data, your own data, on a distribution storage system. So what I mean by that is, and some people kind of get scared when I talk about it in this way, but once you understand how secure and safe distributed decentralized storage is, you will see the benefits, especially from a financial perspective. So the way that SIA works, okay, is let's say I want to store something. I have 1 terabyte, which is 1,000 gigabytes, okay, of pictures that I want to store. Okay, I don't want to pay Amazon $50 a month, let's say, to store that, or I don't want to pay Dropbox $20 a month or whatever to store that data. So what do? SIA has come out with a solution for this, basically, and let's just say that you could pay fractions of the cost of Amazon. For instance, if Amazon is, let's say, $25 per terabyte or $50 per terabyte, I can't remember which one it is, SIA would be 10 times less than that. So between $2, $1 and $2 to store 1 terabyte of data. And you the first thing you think of, wow, why am I not doing this right now? Why am I spending money on Amazon or Dropbox?
People who have apps and different things. Where they
Right,
require
exactly.
server
Why am I
space.
not using SIA right now? Because one, it's still growing, so a lot of people don't know about it. But two, the way that SIA stores your data is the unique thing, and that's why I said
that's where the cost effectiveness comes from. Right?
absolutely. So you can think of SIA as taking your data. Let's say I have one file, they break that file up into hundreds of different pieces, meaning like bytes of data here, bytes of data here, bytes of data here, and then they basically distribute that entirely across a globe of computers that are dedicated to growing Sia's blockchain. And those computers are considered like nodes. So what this means is, and who owns those computers? That's a great question. Those computers are owned by people like me and you. So, and this is where people are like, whoa, this is crazy. There's no way I'm going to do this. I'm not going to store my data on, other people's computers. Like, that's insane. Like, what if they have access to it? So this is where, like, once you learn about like the decentralized network and the security of it, you'll understand that the people who store your store your data have no idea whose data they're storing, and they have no idea what that data is, and they have no way to access that data. Impossible. It's just the way that it works, using cryptography and public and private keys. So there's no way that a person would know where your data even is on their computer. Like, they can't even see like, oh, the person's data is in this location. It's all like embedded into the operating system of that person. And how do those people like actually store your data, right? So that's where Sia, I think, has an awesome business model. So people who want to rent out their storage space on their hard drives, on their computers, on their cloud storages, can just say, hey, I'm willing to store 500 gigs or half a terabyte of data on my personal computer, my personal device. So what Sia will do is, when people are using to buy Sia storage, like they're basically paying for the storage space, right? They will say, hey, I need to store these 10 gigs, right? So this person A, who has the 500 gigs of space, he'll be like, okay, right? He'll automatically get selected, right? He's like, okay, I have the space, and he'll go there. But maybe I should backtrack. Not quite automatically, based on what the renter of the space is willing to pay. So there's where the market cap has now been created for Sia internally. So people are saying, okay, I want to only spend around $1 to store my 1 terabyte of space. Who is willing out there on the Sia network, willing to host my 1 terabyte of data for $1, right? And so I think that's where, again, smart contract comes into play. Person A wants 1 terabyte of space, right, for $1. Person B is like, over here, hey, I have 500 terabytes of space, or yeah, I have like 50 terabytes of space. I can give you 1. I'm willing to pay. I'm willing to charge only $1 for it. Boom, that contract is met. What's really interesting is Sia does this transaction with their own coin. So it's called the Siacoin, right? I'm not sure if it's Sia or Sia, but I'm just gonna call it Sia. So let's say one coin, like $1 worth of Siacoin, is like 100 Siacoins, right? So that means that a person is willing to pay 100 Siacoin, right, to rent 1 terabyte of space on somebody else's hard drive around the world, right? And also, what's really interesting is, I should backtrack, that one person alone doesn't store all of your 1 terabyte of space. Multiple people across the world will store your 1 terabyte of space. So
in case it was hacked, in case it was lost, in case whatever.
Yes, and what's really cool is that Sia multiplies your data by 30. So basically, the way that it works is, like, at any time, if you want access to your data, let's say person A over here has like 10 gigs of your 100 gigs of data on his machine, right? So you need those 10 gigs back if you're trying to view your data, right? So that person has to keep his Sia host up and running, right? So that your data can be accessed at any time. Because if he goes offline, and for instance you want to see your data and it's not available from that person, even though it's redundant somewhere else, that person will be penalized. So there's an incentive for that person to keep his host running, because he's going to get paid in the coin after that contract expires. And I think Sia contracts are about 6-month contracts. So after 6 months, that person will get the Sia coin. So it's being held by the contract for X amount of time. Remember, we said there's a time expiration time on these contracts. On that time, that contract is being held for that long, and as long as person B is keeping his host up and running, he gets the coins, right? And he needs to keep, like, let's say 99% uptime over the course of a month, which means he can only be down for, let's say, like 7 hours, which is pretty much impossible to be down for more than 7 hours if you're a host, unless there's like a catastrophic outage in your area. But so the way that it's going to grow, right, is that people will see the value in this decentralized storage. Right now, consumers like me and you, like just regular small people that want to store like their own personal data, are using SIA as like a really cheap way to store data. But what SIA's real goal is, and what their real plan is to basically take this to obviously an enterprise and eventually internet level, which means that they want all storage in the world. Think about it. Big data is like one of the biggest problems in the world today. It's increasing at an astronomical rate.
I'm going to interrupt you here. How much data do you think Snapchat uses? Because what I noticed about Snapchat is that it when you save that, you're not saving that on your phone anymore. I think in the beginning you were saving all the stuff to your phone. And you can imagine if they're saving everybody, because people will just go through different places and record and then just save it. It may not even use a lot of that, but it's always there available for you.
Yeah.
So they have a ton of use, right? So like if SIA is really 1/10 of the cost, then those contracts that Amazon got, some of the contracts that Microsoft and Oracle and all these other cloud contract, that they got, those are going to start going to things like SIA or SIA, right?
Well, so that's the thing. So that's what people say, right? Like, imagine trying to convince like Netflix or Snapchat, hey, we want to store all your data on personal computers, right?
Yeah.
You guys will have no ability to control that data, right? You guys will have no way of accessing that data or seeing what is that data.
Yeah.
What are they going to say? Hell no, right? So SIA understands this, and obviously it's going to take time for like some of the old school traditional like storage like solution companies or just in general enterprise companies to migrate over to something like SIA, because there's risk. They feel like there would be a risk involved, which again, there is no risk. You just lose your ability to control. And that's one of the reasons why SIA is so popular amongst like the tech geeks like myself, is because we don't want other people to access our data, whatever it may be, right? Why should like every time you store on Amazon, every time you store on Google or any of this Dropbox, they have the right, according to their terms and agreement, to access your data at any time as they see fit. For the same way the banks have a right to take 90% of your money and make more money on it, right? So in SIA, that problem is completely solved, because SIA themselves, the company themselves, has no way of accessing any user's data, has no way of knowing exactly how much and where some user's data has gone. And if questioned by the government, SIA has no way of recovering any specific data for the government, because it is completely decentralized, it is completely encrypted, and there is no access points except for the user storing his data. He is the only person that can recover that data, and that user is definitely anonymous. He's based on an address to his computer, or a wallet address. So wallets are like digital, like just like a normal wallet. It's just a way to hold your cryptocurrency. So he would have a wallet address which gets like his money in and out. So there is no way of tracking like the data back to a specific person. And also to basically keep the host safe and protect the host, SIA has said in their documentation that the host is not liable for any information that he stores, in the sense that like if there's could be illegal information or whatever. Like I'm just saying, I don't know, people don't use it like that, but I'm just saying if there was a chance that people were hosting illegal or like international secrets.
I feel like international Jewish criminals might want to store their child pornography on there. So.
And SIA would have no way to track it, unfortunately. But the thing is, this is where SIA would absolutely win. And I think the way they would win is by creating just a layer to this kind of decentralized stuff that, again, the company would have access to. So for instance, Amazon could have have their storage across around the world, but use SIA as a way to retrieve that storage. That way the cost of an individual data center is kept lower, right? So there's ways
So
to
Amazon would work it out with SIA as opposed to giving up their contracts, and Amazon and other of those types
Right.
of companies would lead the process of mass adoption.
maybe Amazon would be one of the last ones to leave, but maybe something like Netflix, for instance, that's a good example. Like, so instead of Netflix paying like Oracle or wherever, like database service or service layer to store all their content data, which is going to cost them hundreds of millions of dollars a year just to store their data. You're basically storing all that data at 10% of that cost. So you're saving companies hundreds of millions of dollars, and that process. And as they make it more efficient, because right now SIA is still like maturing and it's not as adopted as it can be over time. The minute they get a Netflix, the minute they get a Dropbox, that's it. The sky's the limit with SIA. Because if you build that kind of enterprise level trust with the company and the integration is smooth, and so people that are Dropbox users are actually literally their data is being stored across multiple nodes across the planet. They have no idea that that's happening, and they don't even need to know. All they need to know is that when I go to my Dropbox, my files are there, and I'm able to download them or view them, right? So if you keep that part of SIA abstracted from the end user, like me and you, more people would be inclined to trust SIA. And that's, I think, where SIA will be powerful. And that's really
what is SIA currently trading at?
So SIA currently is trading at, let me see, it's about, actually I'll have it right here on my phone, it's much faster. So SIA is currently trading at $0.0037. So what this means, it's at
a third of a penny.
A tenth of a penny. Yeah, a third of a penny.
Okay.
It's basically around a third of a penny right now. So you might think, wow, that is.
So what would $100 yield? 3,000.
$100 in SIA would be
30,000.
about 25,000 coins from the
25,000,
top of my head,
okay.
if I'm calculating this correctly.
All right. And
So, yeah. So like people like are just like, think about it this way. Bitcoin was around the same price when it first came out, right? Not saying, and I'm definitely not saying that SIA will ever get to that kind of price range. Nobody knows. It's highly unlikely that something could get to that price anytime.
going from 0.003
Right, from
to
0.07. Like, what is the
$6,000.
to $6,000? I mean, that is going to take, like, for instance, Bitcoin came out in 2009 and it is now 2017. That took 8 years for Bitcoin to get to that level. Some coins like skyrocket much faster, like Ethereum, but even Bitcoin itself skyrocketed. So remember, back in March, I'm going to use the same example for Bitcoin. In March, Bitcoin was like $700, which is still a lot, but think about it where it is today. So if you had bought, let's say, 3 Bitcoin, right, you'd basically have tripled your money. More than tripled, right? 3 Bitcoin would be now worth 18,000, and you pay 21. So you multiply your money by 9, I should say. So, right? But nobody knows these things, right? Nobody knows. It's all based on supply and demand. But the way I would advise for anybody is, yes, if you're interested in crypto, figure out what that coin, like what the project for that coin actually is. So for SIA, it's decentralized storage, right? And think about how valuable it could be. Right? And if you're not sure, like, talk to somebody with, technical knowledge and say, hey, what are some of the challenges that technology is facing today? What are some of the big problems that cryptocurrency could solve today? And so for me, I just immediately was drawn to the data storage problem because it's just so expensive to store. On Amazon, for 1 terabyte, as a consumer, you're just paying $25 a month, right? But what about small businesses, right? Like, they could really benefit. What if instead of 25, you're paying 2? You don't really care where your data is stored as long as it's safe, as long as people can access it. If you're just, like, let's say, storing like all of the transactions that happen at your little shop, right? For instance, when people swipe, you need to store that data somewhere, right? This would be an awesome platform to do it because that data is secure. Nobody can access that data, and you're paying fractions of the cost. And as a small business, obviously every dollar matters. So a lot of people obviously are willing right currently to pay 10 times more for the safety and security. But what they don't realize is if you're cool with Amazon viewing your data at any time, or if there's a government investigation, let's say against Muslims or whatever.
Well, Amazon is basically the CIA, to be honest. Bezos has a lot of interlocking contracts with the CIA, especially through the Washington Post.
Your data is being sold on a daily basis, right? Anytime you Google anything, right? Yeah. Like, let's say, for instance, I was Googling a certain, like, I was Googling the iPhone, for instance, on
and
the other day.
All of a sudden,
then
your entire Facebook feed is iPhone.
Like Apple stuff, right? So, like, your data is being sold without you even knowing. And I think some people are okay with it. Obviously, and some people are just like, wow, this is like really invasive or whatever. But ultimately, Sia kind of combats both by saying, hey, it's non-invasive and it's extremely cheap.
Tell us about Ripple, because Ripple is another one that's also trying to solve problems. Obviously, technological investment is based on problem solving, and once you solve problems, if you can solve big enough problems or create big enough problems to solve, then obviously there's a ton of growth.
Man, you're really switching it up on me, man. Going from Sia to Ripple.
Yeah, tell us about Ripple, man.
All right, so we can go back to the whole banking industry on Ripple, because that's where Ripple has its big impact. Like I said earlier, like transaction costs for buying and selling through any credit card or any debit card or whatever cost money to the business, right? That is, has their machine set up or whatever, 1%, 2%, whatever the rate is, whatever deal they got. And overall, over the course of a year, you've gotten like $1.6 trillion in transaction fees in using, credit cards with the current system, with Visa, MasterCard, all those things, which is insane. So, and also like sometimes when you're making transactions, for instance, wiring a transfer or just sending money anywhere in any way, sometimes it's really slow, like, between 3 to 5 days. Sometimes it's unreliable. For instance, your bank won't allow you to transfer. This happened to me. My friend once, he was trying to transfer, he was getting a transfer in from a client that he was working with, and that $1,500 didn't come through because his bank was like, hey, this money is too much to be coming into your account. We're gonna block this transaction, right? And so basically, a middleman stepped in and decided, your business for you. And thus, now that my friend had to wait an extra, he had to go to the bank specifically and be like, yeah, allow this transaction to come through. I'm getting paid, right?
That whole thing, the wires and everything else is just
and
terrible.
now, like,
you've taken
your turnaround time is now 3 to 5 days.
Right.
You're waiting for that
and
money.
they're holding the money because they're making money on it. That's just a simple fact.
Obviously, right? Like, so we know that's happening, and they're just making it harder with all the hoops to jump through, right? And there's so much you can do if you had that money 3 days earlier, right? Like if you saw an awesome move, for instance, earnings on Apple.
Well, let me give you a very specific example.
Yeah.
Earlier this year, I was watching Amazon for weeks and weeks and weeks, knowing that it was going to break out. I mean, based on its trends. And, I made a couple mistakes jumping in a little too early a couple times, but didn't lose much money. And I wanted to wire $1,000 to jump into Amazon, and it didn't show up in my account. And Amazon took off. And then by the third day, it was there. But then at that point, I was too scared to jump back in because it already had made the big move. So, I missed out on one of 2 big moves Amazon made this year just because of that.
Yep. And so that's what Ripple is trying to solve, right? So Ripple is basically an enterprise blockchain solution for global payments, for transactions. It takes going through a bank out of the equation. And what's really fascinating is banks are using Ripple to make their transactions, to make their global transfer payments. Mm-hmm. For instance, some banks that are currently using Ripple, BMO, CIBC, UBS, RBC, Royal Bank of Canada.
Now, what makes their what gives them the facility to move faster?
Because the way that the blockchain works, right? So, for instance, as soon as the transaction has completed, right? If both parties are using Ripple and using something called RippleNet, I guess it's their way of making those transactions, but it's built on top of a blockchain, custom blockchain by Ripple. Once the payment goes to RippleNet, it's just like seamless. It's like a quick pay. It's like a local quick pay, right? Like if you quick pay me $100 right now, I'll have it instantly in my account, right? So that's how RippleNet works for mass transactions, for wire transfers, for bank to bank.
There's no limit on the amount.
I'm not sure about the limits.
And how long has Ripple existed?
Ripple has existed. Let me see. I'm not too sure about that right now. How long it's existed for, but all I know is that it's picking up extremely quickly across multiple like financial institutions, and it's a matter of time before banks go to Ripple, and this could render like forget credit card processing. This could render the credit card transactions like useless. Why would you use why would you use credit cards?
It doesn't.
Why would you accept credit cards?
Doesn't it? No, but doesn't this require capital to be available? Credit is based on hypothetical capital that you assume to pay back.
Or debit cards for that instance,
Well,
right?
I'm talking about debit though. Debit, this makes sense for, but how does it make sense for credit? Because credit is like kind of theoretical money. It's not there, right? So
Well, the transaction cost of credit, do businesses not pay for those transactions either?
no, they do. Credit is
exactly.
more expensive. Right?
Well, that's what I'm saying. So like it takes both out of the equation. There's no reason to. I'm sure I don't know this right now off the top of my head, but I'm sure Ripple is either has or is working on a credit strategy as well for the same thing. And that's why banks are involved too, right? Because like and that's why I really like Ripple, because the banks are gonna do whatever they can to stay in control, to stay in power.
Mm-hmm.
So why not invest in something as the common person, into something that the banks will one day find extremely valuable and will thus pay a lot to get Ripple, because Ripple has its own coin, Ripple coin or whatever you want to call it, and it has value.
It hasn't experienced a massive uptick in the price, right, in value yet, has it?
No, not yet. Okay. No, so it's been hovering out.
So potentially options available to individuals who want to get into cryptocurrency and feel like perhaps they may have missed the boat on Ethereum and Bitcoin. You have Sia and Ripple, then, right?
Absolutely.
As potential.
Yeah. And there's others out there too. I mean, like for instance, Arc. Arc is a coin that allows blockchain transactions to occur between different blockchains, right? So there's nothing like that exists. All current blockchain transactions occur within the same blockchain. For instance, I only use Sia to do my decentralized storage transactions. I only use Ripple to do banking transactions. But what if I want to do a blockchain transaction, like I'm selling my data, for instance, to somebody else, right? So I could use a combination of Ripple and Sia eventually, and maybe Arc. Arc is that kind of like that middleman blockchain to do this. So Arc is very intriguing as well. They're not where they need to be in order for that to happen yet, but they definitely have something there. People are spinning up new coins every day. Some have like real good use, some are just for fun, right? There's plenty of companies out there that have literally launched a coin and done an ICO, which is an initial coin offering, and like made a ton of money and just bounced. So you have to be careful in what you invest in. I would not invest in like something that like literally just came out without doing a ton of research. Sia has been around for a few years, and their devs are working every day on improving their platform. Ripple's also been around for a while, and they have a great product. Think about product. Think about what problems that coin is trying to solve, or that blockchain technology is trying to solve. The coin is just a means of transfer, of transaction, right? And the coin gets value as more people adopt that technology or use that technology. For instance, same with Sia. More people get on Sia, the price of Siacoin goes up, right? The more people that use Ripple has now become more popular. So I'm very interested in both of those specifically. Don't take my word for it necessarily.
Right.
That's just
don't
what I
ever
would
take anyone's word for anything.
Absolutely. Do your own research, man.
Yeah.
Do your due diligence on everything that you invest in, no matter what it is. I'm just trying to get people interested. And the cool thing is, hey, even if you've missed the boat on Ethereum or Bitcoin, you can always buy fractional units. So you can buy 10% of an Ethereum, which is $30, right? So you can invest that way. I would recommend, in fact, that's a sound strategy.
Okay, yeah. Let's before we close, let's go into how they actually functionally can start getting involved. Like the most easiest, applications to use that'll allow them to, switch between different currencies, sell, buy, etc., keep, maintain, and monitor.
Absolutely. So the way that you, for instance, buy Bitcoin or Ethereum, right? Those are very popular ones. There's something called Coinbase. Okay, so Coinbase ties your banking card, to their app, and you put money in to Coinbase, like actual US dollars into Coinbase, and then you can go and buy Bitcoin or Ethereum directly with your money on Coinbase. So let's say I want to buy one Ethereum, so I have to make sure that I have at least, let's say it's around 300. I have to have at least $300 to buy one whole Ethereum, right? So that's how Coinbase works. So you just create a Coinbase account, connect your banking information, or your card information specifically, and I think there's limits on what you can put into it daily or weekly or something, but those can increase over time based on your activity on Coinbase. And then, for instance, if you want to buy something like Sia, so coins outside of Bitcoin and Ethereum are known as altcoins, alternative coins, because one, they don't have the massive market cap that Bitcoin has, which is over almost 100 billion Bitcoin's market cap today. So they are known as alternative coins. So the way those work is, again, you use Coinbase you buy Ethereum or Bitcoin, whichever you prefer, and then you send that Ethereum to something called an exchange. Just like a stock exchange, there's something called a crypto exchange. So the one that I work with, the one that I use frequently is called Bittrex, Bittrex. So you can Google that. And what Bittrex is a way to exchange your coins. So I would send one Ethereum to Bittrex, right? And I would then proceed to exchange that Ethereum for Siacoin, for instance. So now one Siacoin or one Ethereum is worth like 70,000 Siacoin because Siacoin is $0.003 US dollars and Ethereum is worth 300
and it blew
US
up
dollars.
this year, right?
And it blew up massively this year, right? So then once you make that transaction, then you can send your altcoins like Sia or Ripple to their designated specific wallets. So you just Google what is a Sia wallet, what is a Ripple wallet, and those are typically software wallets that you download on your normal computer, and those coins are safe. I would recommend to not keep your coins on the exchange because the exchanges have been known to be hacked. Bittrex hasn't been hacked in recent memory or yet, but every exchange is vulnerable because they don't work on a blockchain. There's just a means of transacting coins. So somebody could come in and like swoop in and like steal some coins.
So perhaps you maybe want to make a quick transaction, but then not
so you
transacting the time. You just have a certain kind of base that you've created in terms of your investment strategy and your mix, and then just leave it as such. And then maybe like whenever you're making a big transaction, transitioning from dollars into a variety of or a mix of crypto, then that's when you do the transaction, but you don't keep it on the exchange.
And then exactly, you don't want to keep it on the exchange. You want to keep it in your private wallets because those wallets have a wallet address and nobody else has that wallet address. Those are very unique addresses and nobody will ever know what those addresses are unless you literally give it to somebody. So do not obviously ever do that. Otherwise they will steal your coins because they will just send from your address to their own address. So the way it works is then when you want to sell, right? You take it from your wallets, you send it to your exchange address, and then you change that back to either Bitcoin or Ethereum, for instance, Sia, right? And then you convert that Bitcoin or Ethereum back to US dollars and then transfer back to your account. So it's a lot of hoops you have to jump through right now, which is unfortunate and it kind of sucks. But once you like get used to it, you'll get the hang of it.
That's what happens when you adopt something early. They haven't figured all of it out, but then you take advantage because you got
But if it
in
ever
early.
if the market cap grows on some of these coins, then Coinbase will start integrating those buying and selling of those coins into their own software. So then you'll use something secure like Coinbase to just straight up buy Sia or straight up buy Ripple, right? Because right now that isn't available on Coinbase, just like Bitcoin and Ethereum and one more Litecoin, but so yes, so that's basically and I would recommend as an investment strategy, if you like a few coins, don't put all your money, don't put massive amount of money into the coins, even the ones that you like. I would say, $50 to $100 in 4 or 5 different coins that you like.
Well, everybody's risk tolerance is different. So what I would recommend is like have a general investment strategy, whether it's real estate, options, whether it's CDs, whatever you guys do, you know, in terms of that. But then take a small percentage of that and consider getting into crypto and do the research.
And then also at the same time, diversify in crypto, however you see fit. But it's nice to diversify because, maybe the coin that you invested in, the one that you really believed in didn't moonshot, but one of the other ones that you happened to put a couple $100 in, like went to the moon, right? So then like you basically like, because the trend is up. Most cryptos, most popular cryptos, the trend is over time up. So it's an incredible market that we're in right now, and people are seeing the value in this. The Chinese are mining Bitcoin like every day, right? They're trying to get as much Bitcoin as they can because the one who has Bitcoin right now rules the world at some point. Because like there's only 21 million, right, overall, right? And not all of them have been mined yet, right? So every time somebody mines, the block reward is 12.5, 70,000, and you're just gonna keep holding that because right now it's worth 70,000, but it could be worth 700,000, right? If a single Bitcoin goes to 60,000, right, then or 50,000, just for sake of math, then a mine reward is almost $1 million, right? So obviously the average person who doesn't have the computing power can't do it, but that's why people pool their mining. And so what mining means is like basically again going against the blockchain, trying to add to that blockchain's ledger, trying to add another block, and that's the reward you get for mining. Personally, I've invested in a Sia miner because I believe in Sia so much, and I hope to start mining sometime next year with Sia.
Okay, well, thank you very much, Saad, and really appreciate it. And any updates you have, definitely send them my way so I can update the viewers about crypto. It's obviously a massive subject. It needs a thorough review, and but getting involved in these types of things early can prove beneficial long term. And, you know, they do want to keep us on the slave system of being consumers and employees and not being able to be independent and work for ourselves, or, you know, live our life according to the lifestyle that we choose. So these are things that could facilitate that and expedite that process for us. So thank you again. Appreciate it.
No problem.
All right.